Hey guys, and welcome back to another video of Personal Finance New Zealand with your host, Labuschagne. And today I'm really excited about this video because it's basically about how to set up your personal finances in a really automated way so that you don't have to feel guilty about your everyday spending and that you can have peace of mind that everything's taken care of in terms of your bills and all your savings, goals, and everything like that automatically. So in terms of the structure for this video, we're going to have, firstly, we're going to go through all the bank accounts you're going to need and which ones that I use. Then we're going to go through my 3-step process of how to implement the strategy. And thirdly, we're going to go over the case of what happens when there's some big expense that throws a spanner in the works, like how do you actually deal with that? And I've got a procedure for that basically. So jumping straight in, we have the bank accounts. So the first bank account you'll need is a central bank account, and this is just any bank account, ideally with no fees or anything. It doesn't have to earn interest, but I personally use the Heartland You Choose account for this, which earns a bit of interest on your money, and it also has an ATM or a FBOS card connected to it, so you can access that money if you really need to. And this account will always have a buffer of at least $1,000 up to 1 month's worth of expenses, whichever is bigger out of those two. And we'll get more into what that is exactly in a second. The second account you'll need is an emergency fund. So this is going to be as high of interest rate as you can without any restrictions or requirements for earning bonus interest. Again, for this I use a Heartland direct call account, which is just a no strings attached savings account. And ideally this should be a 3 to 6 months expenses, but at minimum, once again, about $1,000 is good, and no more than a year's worth of expenses in this account. The next account that you're going to need is one sinking fund or multiple sinking funds, depending on how you want to do it. I personally just have one sinking fund, and again this is another Heartland direct call account, and yeah, pretty much the same properties as the emergency fund. The next account you're going to need is a general savings account. Now this one is where you want to really maximize the total interest that you can get, so even if it means having some sort of requirement of deposit. So for me, I use the Rabobank Premium Saver, which requires you to increase the balance by $50 a month to earn the premium interest, but that premium interest is essentially the highest rate that you can get in general across all the bank accounts in New Zealand, and it's been consistently like that for quite a while. The next sort of 2 accounts is essentially just 2 debit cards. Now I'm sure most of you will have at least one debit card, with an account attached to it, but this system, I'm suggesting that to make it the most efficient and easiest for you, you're going to need 2 debit cards, and I'll explain exactly why you need that later. Personally, I have like a BNZ debit card and an ANZ debit card, for example. Okay, so how do you actually operate the strategy? What is the strategy? So the first step out of the 3 steps to implement the strategy is to identify and categorize all of your expenses. So this will mean going back through your last month or 2 bank statement and looking at what are you actually spending your money on, and you need to categorize them into these categories. So firstly, fixed monthly bills. So this is direct debits, meaning the company just pulls money automatically out of your bank account. That's just a fixed amount every single month, so you want to write that down somewhere. The next one is variable monthly bills. So this could be like bills that are based on usage, so maybe like your electricity or your phone plan, or if you have a fuel card or water or whatever it might be. And essentially what you have to do for this in terms of putting it in your budget is work out what it is on average and sort of overshoot that just slightly, just to make sure that it's definitely covered every month. And then you want to put that and pretend that whatever that number that you calculated, pretend that that is what it is every single month fixed, and then put that, write that down in your budget. The third thing you're going to need is to work out what all your subscriptions are per month on, that you have to pay with a card, like a debit card or whatever, and you want to write those down and figure out what that is and add that to your monthly budget as well. The next thing is what is any savings or investments that you want to do absolute minimum every month. So for me, I have at least $50 that goes to that Rabobank Premium Saver account, which is just general savings, and I have another amount that goes into my sinking fund, which I'll explain a bit more later, and then also topping up any investment or brokerage accounts, just any minimum amounts that you want, and write those down as a bill essentially. And the very last part of this budgeting process is to write down what are all your variable expenses. So essentially this is going to be all your fuel and food and eating out and entertainment and all of that sort of stuff. Now essentially you're going to take your income and subtract all of those fixed expenses, so everything except for that last category that I just said of variable everyday expenses, and that includes your variable monthly bills that you've averaged out and come up with a fixed monthly number for. So you're going to take your income, subtract all of that out, and whatever's left, that is the amount that's left for your everyday spending. So step 2 is to set up automatic payments to pay for all of these. Now the direct debits are automatically already going to be set up anyway, but in terms of your minimum savings and investments, you want to set up automatic payments to pay for those and move that to wherever it needs to be, and as well as every month, or you could do it weekly or fortnightly depending on how much you trust yourself in terms of budgeting. You want to take whatever's left over from taking all those fixed expenses and subtracting it from your income, and whatever's left over, that's your budget for your everyday spending. So you want to withdraw that amount from your central account every single month or every week or every fortnight, however often you want to do it, and that goes into your everyday account or debit card. So essentially this is the real key to this whole strategy, is that whatever's on that debit card, you're completely free and clear to spend, and it also forces you to stick to that amount every month. So pretty much, if you're spending too much and you have to withdraw from savings to buy groceries, then you've spent too much. Instead of having that card connected to your main account where all your bills are coming out and you're getting paid in, and it's just all messy. It's completely separated, and it's sort of like having a layer of separation between where your money comes in and what you're actually allowed to spend. That's the main key of this whole video if you don't take anything away. So the third step, before we get to the last component of this video, is at the end of each month you basically want to do a review of your finances. So if there's been any leftover money either in your central account or your spending account, your debit card, then you want to firstly use that to replenish your buffer in your central account. So let's say there's been some unexpected expenses, and you need to get your central account back up to that $1,000 or whatever your 1 month's worth of expenses is. Then you want to top that up first. Otherwise, if that's already topped up, then you can just move any excess into either general savings or put more towards investments or wherever you want to put it. And then lastly, in this third step, how to use a sinking fund. So a sinking fund is essentially there to help you save up for expected expenses that don't happen on a regular basis. So for example, your car registration might be only once a year, or your WAF might only be every 6 months or once a year, or your insurance premiums, you might pay them 6 monthly or annually, whatever it might be. Essentially what you do is you take that amount, you work out how much it is per year, and then you divide it by 12. and whatever that amount is, you set up an automatic payment from your central account into your sinking fund, so that by the time that expense comes up, you essentially withdraw money from your sinking fund directly after you've paid for it from your central account to top up your central account, so that it's as if that expense never even happened. It's always just the same amount every month. I hope that made sense. Alright, lastly in this video, I just want to go through, maybe an objection that's been screaming in your head this whole video. What if there's some big expense that comes up and it's like completely throws out this whole budget that you've come up with, Liam, and it messes everything up, and there's nothing to fear. I've got a procedure for that. So essentially, if something comes up that you have to pay for right now and it's not been planned for and it's not budgeted for, then you pay for it. That's all fine, out of your central account or even your spending account if it's small enough for that. Then you make sure in your monthly review you top up your buffer, and if your buffer is not enough to cover this big expense, essentially this is the ordering of savings accounts and places that you can drain money from to ensure that everything is paid for. So this is the ordering. Firstly, you use your central buffer to pay for it. If that's not enough, or by the end of the month that's been depleted, then you withdraw from your sinking fund and top up your buffer, or pay for that expense. If that's still not enough, then you can draw from your general savings account. If that's still not enough and you've drawn from all your other savings accounts that you might have, then you can draw down on your emergency fund. And if you've depleted your emergency fund, then you can start selling investments, and you want to try to avoid that at all costs, because compound interest, you can go research that, but you want to try to avoid that at all costs. So only after your emergency fund is depleted, then sell down investments. And if you've sold down all your investments, so essentially you've got no money to your name, then you probably have to look at getting like a personal loan, or applying for some sort of financial hardship. So yeah, thanks for sticking around in this video. I know it's a little bit long, I tend to do that, but I really hope that I've covered everything, and if you have to rewatch this video and skip around and do what it takes, but yeah, I really hope that that's helped and that's answered your questions, and that you've enjoyed it. So yeah, thanks so much for watching, and please let me know if you have any questions or if you see any holes in this strategy, because I'm keen to fix this video if that's the case. Yeah, see you around. Cheers.